Hello there and welcome to the EUobserver chat show, MEPs Talk About EU. Joining me here today to discuss the topic of an EU financial transaction tax is the British MEP from the Europe for Conservatives and Reformists group, Kay Swinburne, and the German MEP from the European United Left group, Jürgen Klute. So thank you very much for coming on the show, and thank you very much for watching. So without further ado, let's talk about EU. Now, banks must be made pay their fair share. They're the words from President of the European Commission, José Manuel Barroso. For the first time ever, the Commission is exploring plans to slap a tax on financial transactions in the EU, a plan that the EU reckons could raise some €57 billion a year in revenues. With so many Eurozone governments strapped for cash at the moment, it's no surprise that countries like Germany, Spain, Greece and Portugal could support such tax. But the UK, the home of Europe's largest financial district, is opposing, with George Osborne telling the EU finance ministers recently to put the idea to bed. But the idea has not been put to rest, not just yet, and that's why my two MEP guests are here today who are going to tell us more. So first I'd like to start with you, Ms Swinburne. In about 1 minute, can you kind of defend why you oppose the tax and what is your alternative to it?
Well, I oppose the tax because at the end of the day, a financial transaction is actually conducted on behalf of certain investors or certain companies. And so the people who pay this tax ultimately are going to be the pensioners and the businesses. And that, for me, at a time of economic distress is not something you want to do. And so there are two groups who are actually needing our assistance right now rather than needing a further tax. You do not put a VAT on foodstuffs or anything else, changes to VAT, in order to punish the supermarkets. The people who pay it are the customers, not at the end of the day the facilitators, the people who actually apply the tax. So I think it's very important that if we want to punish the banks, we find a sharp instrument to do it. And the way in which I would do it would be a financial activities tax, which actually taxes their balance sheet, their individual activities. That actually curbs their behaviour and makes them actually take less money out of the financial institution in order to give to their shareholders. So that punishes the banks directly as opposed to this. And the problem we have is 57 billion is a drop in the ocean compared to the money that Europe needs at the moment. 57 billion runs the UK NHS for some 24 weeks. That isn't a large amount of money to put the UK's economy in jeopardy.
OK, let's take the other side of the argument. Mr Klute.
Yes, I'm just in the opposite of Kay. I'm in line with the NGOs which are fighting for financial transaction tax for 1 or 2 decades. I think just that's the intention to punish in a way the banks, not really the banks, but the main interest of the financial transaction tax from my point of view is to size down the financial sector and to slow down the financial sector. And that could only be done by a financial transaction tax and not by a bank activity tax. I don't agree that the customers and the pensioners have to pay. I think a part of the customers will pay, but not the customers of the retail banking sector. The proposal, the draft of Commissioner Šemeta, makes some exemption, especially for this sector, for normal bank transfers in the retail banking sector and for pensions and so on. And I think that's not really right. But if the people there take part in the investment banking sector, they should pay. That's our interest. They should pay, yes.
OK, so now we've got two MEPs' opinions, and now let's get some more opinions from various sectors of society. The other day, as I was on my way into the Parliament, I came across a lady who was burning the EU flag, and to her right was a man who representing the UK Independent Party who was completely against this financial transaction tax. You'll find out now in this video. Have a look.
We represent the United Kingdom independence.
OK.
I'm not a member of that group, so I'm independent.
We're all quite as angry.
OK.
We want to see a lot of reforms.
Okay. So what kind of reforms do you want to see?
Well, basically a lot more democracy. And also things like the financial tax are not in our interests. So Angela Merkel wants what's in her interests. We obviously want a little bit of what's ours.
So Oxfam is very concerned by the impact the economic crisis is having on the poorest people around the world. And people in developing countries are being hit even harder. There are people losing their job every day. Public services are being cut. And more people are falling behind the poverty line. Oxfam believes that now is the time for the financial sector to pay the cost for a crisis it has created. In this regard, the financial transaction tax is a perfect tool. Our estimation says that the financial transaction tax could raise up to 200 billion euros per year at the European level.
Financial transaction tax is an extremely simple tool, very easy to implement, very easy to collect, very cheap to collect. For example, in the UK, they also have a so-called stamp duty on trading shares in the London Stock Exchange. And the UK Treasury used to calculate what is the cost of tax collection. And collecting the stamp duty has the lowest collection cost per revenue. So the financial transaction tax is a very simple tax. It's a blunt instrument because it taxes everything, not just those that are harmful, but also taxes, the trading of, let's say, pension funds who are managing the savings of the people. So certainly it would have negative side effects, but it's much better than nothing.
So that was the Hungarian economist Derzsolt Darvas from Bruegel. He seems to be very pro that tax. So what do you say to that, Ms. Swinburne?
Well, I think he's saying it's a very easy tax to apply, and I think what's also easy is to avoid it. And what we see in the UK in particular, who's had a stamp duty applied to stocks and shares for the longest period of time, the vast majority of financial institutions do not pay that tax. They actually have created a new market called the CFD market, which doesn't actually have a tax applied to it. But the retail investors in stocks and shares, the likes of you and I, who have a pension fund, pay that tax. And so that for me is classic as to why this is not going to work, including the fact that trading is global and it is mobile. And London is a booking centre for global trades, which have nothing to do with the EU at the moment. They actually are booked in London, but they do not necessarily have a strong EU component to them. They will move overnight to Singapore, and we know that they've already changed their national legislation in Singapore, ready to accept these trades. 57 billion is less than 10% of the current trading volume in Europe. They're assuming in the Commission's analysis 90% will move. How can that be good for the London economy, which actually supports this with jobs, some 50,000 jobs at risk at this point?
I agree with Kay that this is a problem we have to deal with. But as I understood the proposal of the Commission, they found some methods to avoid this tax fraud or this movings. And the method the Commission proposed is that the tax should be paid by the buyer or by the seller and not by the trader. And that means if the trader is in Singapore but the seller or buyer is living in the EU, the seller and buyer has to pay to the EU. That's a strategy to avoid what you mentioned. I agree that's a real problem and we have to see whether it will work. But I think we have to test that before. And in this way, I think I'm more optimistic than you.
I mean, I think if we apply this globally, if there were to be no jurisdictions within the world that actually you could go to avoid this tax, I would say yes. But all we have to look at is our offshore centres around the world where the financial havens currently are. And I suspect that they will actually do a roaring trade in booking these. And there will be a lot of people who will find ways of not declaring the income from them. They do it already, and I think to create such a large loophole would actually be doing nobody any justice. If we look at more sophisticated ways of raising revenue from the banking sector, I suspect we will actually get a much better result for everyone.
The thing is, there's so many civil societies that do support this financial transaction tax. There's so many movements out there who are very much pro this tax. So they would look at people who are anti this tax as kind of villain-like, because we've seen how the bankers and the traders, they've been making a lot of money out of this Eurozone sovereign debt crisis. And as Barroso said, and as many people are saying, it's time for the banks to take a bit of this pain.
I think there are many banks taking a lot of pain right now. We're looking at another round of potentially bailing out our banks in Europe. So to say that they need to suffer more pain is a little disproportionate. I think we're talking about hedge funds and various other institutions who are taking very high-risk proprietary positions. That's very different to the banks as a collective. And we need to see the banks as being facilitators for capital into our economy. And the day that we actually say that they are all evil and they're not delivering for our economy and for our growth is the day that we should actually nationalise them all. And so if we want to go down that route, that's the route we should go down. But we should be very careful about making them the villain in the piece. When the standard commercial banks here are not villains, they are trying to facilitate economic capital flow. And so we have to be very, very careful to differentiate about the groups of people we're talking about. We're talking proprietary trading, then actually most of European banks right now are not big traders in that space. So we have to be very careful we don't make them all villains.
Extremely extravagant bankers bonus. How can we cut down on that and get them to share a bit out the pain?
Well, I have to say I would take a financial activities tax pre-bonus. And so therefore the pool for bonuses becomes a very small pool because your tax take is a significant part.
I don't agree. I think we have to give some answer to our citizens. The main reason for the public debts we have at the moment and for this big crisis in which Europe is a banking crisis. The public sector financed the banks, the banking sector during the crisis, that it shouldn't crash down, and now we have this big public debts. You can see it if you compare the public debts before 2008. It was much lower, and it increased only after 2008. It's very clear.
Well, in some countries, in my own, for example, it was increasing rapidly before that. So I don't think it's true for all.
In the most European countries, you can show that the banking crisis was the main reason for the over-indebtedness, for the exceeded over-indebtedness. And I think we have to find a way that the banking sector will pay a relevant part to finance this cost, this public cost.
But make the banks pay and not the pension funds and not the businesses.
I'm not sure. I think the proposal of Šemeta tries to avoid this.
Well, all our pensioners invest through pension funds. So in the UK, it's very much the retail market where they are saving for their private pensions, which the vast majority of people do. When they save for those pensions, or even indeed the state pension provision, they actually invest those funds in stocks, shares, derivatives and other products. And each and every one of them, we asked Commissioner Šemeta a couple of months ago if he would exempt the pension funds from such a transaction tax. And he said no, he would not go down that route. He would not create that loophole. And so without an exemption for those pension funds, the hit to their returns and therefore to people's end pensions is enormous. And that does not seem fair, given that...
And people from all walks of life you're talking about here?
Absolutely, from the lowest paid to the highest paid, their pensions will be hit.
But Kay, on the other side, if you are trading with derivatives and so on, you have to pay bank charges, and the financial transaction tax is much lower than the normal bank charges you have to pay if you trade with this. And therefore I can't really agree with your argument. The customers, the pension funds are ready, are willing to pay, and they're doing it. They do it. They pay this normal bank charges for the normal trading they are doing.
They pay a broker to trade their shares.
Yes.
But the reality here is, though, of course, that derivatives are actually going to be subject under these proposals to a lower tax, an order of magnitude lower. The problem we now have is that derivative instruments will be devised to actually give you the simulated effect of any other asset. Because if you're going to take a tenth of the tax, that's where you're going to do it. The risk of derivative instruments is much, much greater. And obviously the financial crisis, derivative instruments were actually a big part of the exacerbated effect we saw. If we're going to encourage people to devise new derivative instruments to get around paying the 0.1% on shares and 0.1% on bonds, we are actually starting to create a monster just to collect a taxation, which is a very easy to collect but a very blunt instrument. CFDs are case in point. The UK has actually seen this entire class of instruments created purely to avoid the stamp duty on stocks and shares. That, I think, is a huge risk to us. We increase the risk in the financial system for everyone.
Okay, I think like Angela Merkel and David Cameron, you can both agree to disagree. And on that note, we'll leave it there, and we look forward to your comments and your opinion on this supposed EU financial transaction tax. Thank you very much for watching, and take care.